Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome, everyone. My name is Andrew Rocco. I'm a stock strategist here at Zacks Investment Research. I also do manage the Tech Innovators portfolio for our Zacks Premium Services. And I'm going to dive into our top stock pick for June 22nd, 2026. So let's get right into that. And this is one we've covered before. Name is Bloom Energy, ticker symbol BE. But today I'm going to explain why I remain extremely bullish on this Zacks ranked #1 strong buy stock. So first, what does Bloom Energy do? They are a clean energy and fuel cell provider that designs, manufactures, and installs solid oxide fuel cell systems that generate electricity on site. And I'm going to explain why that on-site electricity generation is absolutely critical, especially with the AI boom in a little bit. But the company is best known for its energy servers called Bloom boxes. And unlike traditional power plants that burn fuel to create steam and turn a turbine, Bloom's technology generates electricity through a clean chemical reaction. Bloom Energy's technology converts fuels such as natural gas, biogas, and hydrogen into electricity without combustion, delivering high efficiency and lower emissions than traditional generators. So they really have a unique technology in the energy field. And the reason this is so important is the current AI boom. So as you can see on the chart, the artificial intelligence boom has already become the largest industrial build out in history, and it's only expected to grow larger. So here it is versus previous mega projects. You could see 930 billion in 6 years. This is probably already outdated, this chart, but it just gives you a visual of how big this build out is and how there's really no end in sight currently to how much these hyperscalers are building, are putting capex into these data centers versus historical industrial build outs. Now, let's look at AI related capex. And you can see AI related capex, it's expected to grow more than 70% year over year from 390 billion to 674 billion. And AMD CEO Lisa Su said, AI spending is unlikely to slow. In the past 12 months, all of our customers have said demand is accelerating because now we are starting to get real productivity out of the AI use cases. So in the beginning, everyone was worried that this AI spending won't pay off. Now the AI spending has proven itself. It's starting to show up in earnings, and thus these companies are not slowing down their spending. They're actually accelerating their capex. And here's a look at AI energy demand and how it's soaring. AI model training is energy intensive, and it will only get more intensive as AI moves into the agentic and physical AI stages. So once Elon Musk comes out with the Optimus robot and other companies come out with their competition for that Optimus robot, these are all also going to require intensive AI training from these data centers. And as artificial intelligence becomes an integral part of daily life and soars in popularity, more compute is needed. According to the Penn State Institute of Energy, data centers consumed about 4.5% of US electricity, and that number could triple by 2028. So even before the AI boom, which requires enormous computational resources, the US electrical grid was kind of already at its limit. So this AI boom is going to put it probably beyond its limit. And that takes us into what, in my opinion, is the most important slide for Bloom Energy, and that's why on-site power is necessary for data centers. So first off, if you're looking to just connect to the grid, now that can take between 5 and 10 years. Again, the grid is pretty much at its limit, so they're not going to let someone just connect to the grid regardless of the rate that they're paying. It'll take 5 to 10 years to get through that regulatory red tape. And with all of this competition going on, these big tech companies don't want to wait the 5 to 10 years. The Trump administration, they announced this voluntary ratepayer production pledge. So the Trump administration has been very pro AI, but at the same time, they're looking to protect regular US citizens, and they don't want to see electricity prices soar. So a bunch of the big tech hyperscalers, pretty much all of them, whether it be Amazon or Microsoft, they've signed this pledge to limit the amount that electricity prices can increase. In other words, they're going to need to provide their own power or pay for what, pay the damage that they're causing to other people's electricity rates. Probably easier to just create your own on-site power. And then AI chips, such as the latest GPUs from NVIDIA, those consume significantly more power. And these hyperscalers, they want this power to be, reliable, and they have this massive base load of energy that they need, and they don't want intermittent from renewables such as solar and wind. They need reliable power. And then finally, cost and hedging. Electricity is the single largest OpEx for an AI data center. Relying solely on the grid and volatile electricity prices could lead to demand charges during peak hours. And that's if you can even get onto that grid, which we already mentioned is very, very difficult. So all of this is bullish for Bloom Energy and other on-site power providers. And then Bloom Energy has some strong partnerships with Oracle, which is one of the largest CapEx spenders. They already had a deal, but in April, they expanded a strategic partnership with Oracle to deploy up to 2.8 gigawatts to accelerate AI infrastructure and that build out. So Oracle does not want to rely on the traditional grid. So them and other hyperscalers are going with Bloom Energy. And then Zacks consensus estimates already suggest that Bloom will deliver triple-digit EPS growth through 2027. In my view, these numbers will likely need to be revised higher as they've gotten a bunch of new deals that probably haven't been taken into account yet by Wall Street. And then the company has a phenomenal history of beating Wall Street expectations. So Wall Street is a game of expectations, and a company that consistently beats Wall Street expectations typically moves higher. And from this perspective, it's difficult to find a better example than Bloom. Over the past 4 quarters, they've beat analysts' expectations by 185%. So they're consistently beating Wall Street expectations, and they're beating them by a lot, which is exactly what you want to see. And then finally, Bloom Energy, here's the daily chart. It's breaking out of this technical pattern. You can see it got support at the 50-day moving average. So kind of all of the stars have aligned for Bloom Energy. They have this AI data center boom, which requires a ton of energy, which we've explained why it's important to have that on-site energy. The chart pattern looks good. The fundamentals look good. So for that reason, we continue to be bullish on this Zacks ranked #1 strong buy stock. And for the second top stock pick of the day, Brian will take it from here. Thank you so much.
Thanks, Andrew. Brian Hayes here with Zacks Investment Research. I've got another exciting pick for you, so let's jump right into the action. My top pick operates as a diversified, multinational healthcare enterprise that primarily serves underinsured and uninsured individuals through government-sponsored programs. The company I'm referring to is Centene Corporation, ticker symbol CNC. So Centene is a leading provider of government-sponsored healthcare with a dominant position in Medicaid and a rapidly expanding Medicare footprint. The company operates through 4 segments: Medicaid, Medicare, commercial, and other, and ranks among the largest healthcare companies in the country with approximately $191 billion in total projected revenues and a spot at number 19 on the Fortune 500. It's also engaged in providing education and outreach programs that help members access quality, appropriate care. After navigating a challenging 2025 marked by rising medical costs and a withdrawal of guidance that battered the stock, Centene has executed a methodical recovery. Management's relentless focus on Medicaid margin restoration, disciplined cost management, and rate adequacy is clearly bearing fruit, while the Medicare Advantage and prescription drug plan businesses have outperformed internal expectations. The Texas Medicaid expansion has added a meaningful new growth vector, and the company has used its robust cash generation to fortify the balance sheet, reducing total debt by $1 billion in the first quarter alone. The consolidated health benefits ratio has steadily been improving, a key signal that the worst of the medical cost pressure may be in the rearview mirror. So, after a difficult 2025 that saw the stock fall out of favor amid elevated medical costs, the managed care giant has come roaring back, supported by recovering margins, surging cash flow, and a powerful wave of upward earnings estimate revisions. This is a stock that is not only highly ranked by our Zacks rank system, but it's also outperforming the market. Only stocks that are in extremely powerful uptrends are able to make this type of price move, and these are the leaders that we want to focus on. So that's a bit about Centene's background and services. Let's shift gears a bit and look at some fundamentals for this company. So Centene is part of the Zacks Medical HMOs industry group, which currently ranks in the top 12% out of approximately 250 Zacks ranked industries. And because this group is ranked in the top half of all Zacks ranked industries, we expect it to outperform the market over the next 3 to 6 months, just as it has over the last few months by a wide margin. Historical research studies suggest that approximately half of a stock's price appreciation is due to its industry grouping. In fact, the top 50% of Zacks ranked industries outperforms the bottom 50% by a factor of more than 2 to 1. By focusing our efforts on leading stocks within the top 50% of Zacks ranked industries, we can dramatically improve our odds of success. And notice that stocks in this industry are also expected to deliver above average earnings growth, signifying a powerful foundation that should lead to higher prices in the future. And moving to our snapshot page here, we can see that Centene is a Zacks rank number 1 strong buy. What stands out is the company's consistent ability to deliver positive earnings surprises. We can see they've surpassed earnings estimates in 6 of the last 7 quarters, and they've delivered a trailing 4-quarter average earnings surprise of nearly 75%, reflecting strong execution. This track record aligns perfectly with the power of the Zacks rank system, which prioritizes stocks showing upward earnings revisions. The company most recently reported first quarter 2026 results that blew past expectations, posting adjusted earnings per share of $3.37, a figure that surpassed the Zacks consensus estimate by a remarkable 80.21% and climbed 16.2% from the year ago period. Revenues of $49.9 billion rose 7.1% year over year and topped the consensus mark by 5.2%. And on the heels of that beat, management raised its full year 2026 adjusted EPS guidance to greater than $3.40, up from a prior floor of greater than $3, and lifted its total revenue outlook to a band of $187.5 to $191.5 billion. Analysts have responded favorably to the move. Looking into fiscal 2026, analysts have raised their EPS estimates by 15.28% in the past 60 days. The Zacks consensus estimate now stands at $3.47 per share. And let's see how that $3.47 per share reflects nearly 67% growth relative to the prior year. So these are exactly the types of trends we want to focus on when narrowing down our list of potential stocks. And let's take a look at the price performance here. We can see that Centene has transitioned from a falling knife look in 2025 into one of the better recovery stories here in 2026. So the stock bottomed out last year near $25 a share, and we can see today the stock has more than doubled, and the shares now trade near a 52-week high. It's exactly the kind of stock we want to include in our portfolio, one that is trending well and showing positive earnings estimate revisions. Notice how shares now reside above upward sloping 50-day and 200-day moving averages. The momentum has clearly been built throughout 2026. With improving fundamentals and a constructive technical picture, Centene appears poised to continue its outperformance. So Centene, ticker symbol CNC, is my top pick of the week. The combination of Medicaid margin recovery, Medicare outperformance, improving cash flow, and a discounted valuation should continue to provide a tailwind for the stock price. With the next earnings report expected in late July, robust fundamentals combined with a strengthening technical trend certainly justify adding shares. I see more upside ahead for this stock. That's it for this week. Make sure to subscribe to our channel. We bring you top stock picks each and every week. From Andrew and I and all of us here at Zacks, thank you for watching. Tune in next week for more of our top stock picks.